Jim is going to be presenting today. Jim is going to be celebrating his 5th year of membership.
I'm very grateful to the group, actually, for having that opportunity.
And Jim has been our mortgage broker the whole time. Not only does he provide wonderful mortgage advice for anybody who calls him, but does a fantastic job when people work with him, as well as giving us from time to time some political commentary. So let's swing it over to Jim.
I'm happy to give people advice about anything. So for those of you for whom Latin is not your first tongue, we'll begin the discussion today with the Latin term mortis, which transformed over the years into the old French term mort. And so that is the derivation of mortal, mortuary, and mortgage.
Yeah.
Just so.
I see where he's going with this.
I just thought I would start off with that. Who would care to hazard a guess as to what the most common question I hear from people that I work with might be?
What's your rate?
No.
How much can I?
What is a mortgage?
No. Why do I have to bring that? Okay. Why do I have to provide bank statements, whatever? That's the most common question that I get. So I'm going to set about to explain that to you. There is recently passed legislation that instituted something called the notion of a qualified mortgage. Now, qualified mortgage creates a safe harbor for lenders who want to be in that business. If it's a non-qualified mortgage, the lender can be sued, and they have to maintain 5% of their own funds in that mortgage. They can't just sell the whole thing off or keep it like some banks might do, or most banks do, actually. So there is a high premium on originating qualified mortgages. Now, a qualified mortgage is defined under the law, and I'm going to try, by the way, not to have you all slip into a coma about this. So remember the name Louis Ranieri. Just remember that name. So you have to, make sure that all of your monthly payments don't exceed 43% of your income, the way that we calculate your income, not the way that you might think about it. You have to have certain credit scores. But the principal thing about a qualified mortgage, actually any mortgage nowadays, is that the lender now has the burden to determine that you will not get into trouble with that mortgage. So the burden shifted from the borrower to make sure that they didn't get into trouble to the lender to make sure they didn't get into trouble. So as a result of all of that, the agencies, Fannie Mae, Freddie Mac, Fannie Mae, FHA, VA, all tightened their guidelines, made them more restrictive. And in so doing, they created a situation where underwriters now, whose job it is to protect the lender from any sort of a risk, the primary risk they're concerned about is that they might have to repurchase that mortgage from the agency. So the underwriters have to be aware of these agency guidelines, and they're underwriting to those agency guidelines to make sure that you neatly fit in that box. And that box is a pretty small box, and it only has 4 sides. So if you happen to have 5 sides or you're round, you're not going in that box. Now, the reason that lenders are concerned about that is twofold. One is they don't want to send any more loans to the agency that can be caused to be repurchased, and the other is that the Justice Department got very, very active and went after Wells Fargo, for instance, and clawed back $18 billion for loans that Wells Fargo had sold to one of the agencies, Fannie Mae, that the agency later claimed were defective in some way. Where do you think the money went, that $18 billion? By the way, that's 18 followed by 12 zeros, which is a stack of money, if it were $100 bills, would reach into the stratosphere. So that money did not go to the borrowers. It did not go to the investors who bought mortgage-backed securities. That money went to the Justice Department to pursue more of these claims. So that's why lenders are so very, very cautious nowadays. is that can happen, and it's actually happened to 3 of the major banks, and they're now going after smaller mortgage banks. Okay, so that's why. Now I'm going to give you an example of just a very recent example, like 3 days ago example. I have a client who's an old friend. His net worth is probably on the order of $15 million, you know. However, it's in transition because right now most of that is in a trust for which he is a beneficiary. Lots of properties in Boston. For 21 years, he's been receiving, money from that trust as the beneficiary of the trust. In recent years, that's been on the order of $11,000, $12,000 a month. Not a bad way to make a living. But because of this rule that lenders have to employ, which says we have to ascertain that the source of your income and the level of your income can reasonably be considered to continue for 3 years or more, he's not eligible for a loan. Because that trust was a 21-year trust, which expires in April of this year. All of those properties are now going to go into an LLC. So it's exactly the same properties, exactly the same amount of money. Now it flows to him personally as one of the members of the LLC. But the income from the trust is going to cease in April. The loan on his house is 10% of the value of his house here in Boulder. Mr. Manger, would you make that loan?
Absolutely.
In a heartbeat.
Oh, I can't wait.
Yeah, all right, we'll be talking. So that's the difficulty that we have nowadays in the modern mortgage market. Let's see. Did I mention Louis Ranieri?
Yes.
Is anybody curious about him? He's considered to be the godfather of mortgage-backed securities, worked for Goldman Sachs. Okay, so he invented the securitization process for mortgages. He's back. So now we have subprime mortgages, again, Louis' invention, that are securitized, that are not QM, but rather are based on, show me 12 months bank statements, I'll get you done. You know, maybe you've had a bankruptcy or a foreclosure in the last 20 minutes, I'll get you done. This is the advent of new subprime. Excuse me. Further, the agencies, Fannie Mae and Freddie Mac, just to make sure everybody has the opportunity to get in trouble again, has just come out with a new loan program called Home Possible. Home Possible will let you get into that new dream house with 3% down. Even FHA requires 3.5% down. And you have to have mortgage insurance, but you can get there. You need middling credit scores. It's considered QM because the agencies will approve it. And it's considered QM because we have to go through our due diligence to make sure that we can reasonably believe that your income is going to continue unabated and at that level or more for 3 years. Okay, so let's see. I meant to start my timer. Where am I with all of this?
You got time. You got about 4 minutes left.
4 minutes?
Yeah.
Okay. So when I enter into a conversation with someone about a mortgage, the first thing I try to do is to learn from them, as most of us here in this room do, what it is they want, what they're trying to get to. And then I pull out my MMW, that's Magic Mortgage One, by the way. And I wave it around a little bit and use what I know to help them get to that place. Excuse me. Sometimes they've already been told it can't happen. Sometimes they were just referred to me, and they like my warm, gentle tones, and were able to listen for a little bit. But the fact of the matter is that in the 35 years I've been doing this, I've managed to learn a thing or two. And so I can look around in the margins and find loan programs that will help that person get to where they're going. That is the advantage of a mortgage broker over a mortgage lender. I'm not naming names here, but if you work for a company that's initials are WF, bank, you will discover that they're a one-trick pony. They can only offer the loan programs available through that bank. I work with over 25 different lenders now, banks and mortgage banks, and I'll make a distinction there for you in just a minute. And each one of them has a little bit different underwriting characteristics, so they'll look at these regulations. Oh, by the way, there were 85,000 pages of federal regulations issued just last year. I haven't read them all. I've tried to read the ones that affect my industry, but that's a lot of homework. You know. But with respect to the underwriting guidelines for these different loan programs from different lenders, they vary. They vary enough that I really do need to read and stay abreast of what's available. So that if somebody comes to me and says, gosh, maybe they were referred by Keith, I just had a bankruptcy, you know, I'm right in the middle of it. I can say, well, FHA will let you get a new loan right in the middle of that bankruptcy, as long as it's a Chapter 13, and you're paying it out, and we can show you've made those payments. And they'll say, gosh, nobody's ever told me that before. And now we take them from their 8.5% loan to a 4% loan and help them just get back on with their life. Somebody might say to me, wow, you know, I've heard all this about being self-employed and how hard it is to get a loan if I'm self-employed, and I need 2 years tax returns, and the income has to be consistent, and I need a year-to-date financial statement to show that it's going on. And I can say, well, that would be true for most, but I can get you done with your most recent federal tax return, as long as you qualify with the income we show there as a self-employed borrower. So enough about me.
That's the 10 minutes. So we have 5 more minutes for questions and stuff.
Yeah, thank you. As I said, enough about me. Are there questions? Wow, I'll let you all stand. It did work. Mortis. Yes.
I have a question.
Yeah.
So, now, say someone has, what would disqualify someone as far as credit score? And what would be the average credit score most borrowers have at this time that could get approved for loans?
Good questions. So VA has no minimum credit score. So, I mean, if you're 350, I can get you done as long as you're a vet. FHA has a minimum credit score of 500. Now, to get a 500 credit score, you really shouldn't be buying a house. But it can happen, and there are reasons why people have 500 credit scores. Maybe, I see this actually a lot, and this is no discredit to either party, but I see people split up, and they're both names on the credit cards, and one of them decides to go out and have a party on the credit cards, and the judge said, you're responsible for those credit cards, but guess what? That person doesn't make the payments. The lender thinks both are still responsible for the credit cards, and so it affects the credit score of the person who thought he was protected by that judge's order. You're not, you know, just so you know. So the average credit score, probably, I really don't know, but I'm going to take a guess, 640. If you have a 620 credit score versus a 680 credit score, for instance, on a conventional loan, that lower score costs you 1/4% of the loan amount. That's what that lower score costs you. It doesn't take much to go from 620 to 660, and I can help you with that. More questions?
How do you feel the current administration is impacted?
Oh, jeez. Take the fifth.
I do have thoughts about that. You won't be surprised to learn, but this may not be the venue.
Just curious.
There are a lot of people who are really advocates for the current administration. Yes, Michelle.
What do you do to make sure that, because most people don't know that when they're looking for a home, often the first step is actually looking into a mortgage before even looking at a home to move the process forward. So what do you do to actually communicate and let people know that, hey, you want to talk to me before reaching out to Kate, or, at least at the same time, instead of
There are
waiting.
27 people sitting around this table right now that do a really good job of that for me. And I'm on Yelp. I got a call just last week, and I referred to Kate as the realtor. So mostly social media, but I'm going to be sending out a change of address form. I'm going to be sending out probably about 1,000 of those to old customers, letting them know that I've moved, give me an opportunity to touch them. But there are many realtors, and most, in fact, if they've got their head on straight, who will say to someone, the first thing you need to do before you go look for a house is figure out how much you qualify for. If they send them to me, the first thing I say is, I'll tell you how much you're going to qualify for. First, tell me where your pain threshold is in terms of the amount of payments you want to be making every month. Do you really want to be foregoing that trip to Thailand, or would you rather have a larger payment and be doing a forced savings plan? So it's easy. You want to know how much you qualify for? Take your gross income. If you're self-employed, do a 2-year average. Take 43% of that. Add up all of your monthly payments, including that proposed house payment. That's how much you qualify for. It's pretty straightforward.
Sounds easy. We could take one more question.
Yes. Let me take Derek.
Sorry. So right now, what I'm seeing along my group is a lot of people that maybe bought, 6-7 years ago that have, their home values have increased by, 50%. But now they realize when their kids are going into school, they're not in the school district they want to be in. Mm-hmm. So they want to, reap the equity that they've gained in their houses, but then they're having difficulty finding, something comparable that's not, double the price. Do you and Kate kind of have a strategy for, for helping those people that especially feel like they're on a time frame because they have to get into a school district, or, I'm just hearing a lot of grumblings about it. And is there an advantage right now still with the market where it is to, get a mortgage on something and actually make that leap versus investing and paying into private school, for example?
To borrow from Dan, we don't make forward-looking statements. Mm-hmm. But here's what I would say to people. I would say, first of all, consider renting your house if you want to move someplace else. It's the best investment you can make to have rental property, period. Mm-hmm. No ifs, ands, or buts. And secondly, you can go rent someplace where you want to live and figure out if you really want to live there and take a little more time buying that next house. Maybe you don't take all of the equity out of your house. Maybe you refinance it, take enough equity out to make a down payment on the next house, but still break even or better on the cash flow on this one. Now, that's what I would say. Okay. We'll ask Kate what she would say.
I agree, yeah. Because the inventory is low enough now where there's no way, it's very difficult to make the break.
Mm-hmm. And we'll ask Dan about investments.
Yeah, well, I think it's a great time to sell a house. It's just a terrible time to buy a house.
Yeah.
If you want to buy in Kansas, I think you're okay. But if you want to sell and buy here, so I think renting strategy and then renting where you want to go for that, and then seeing what happens with the market is definitely a good way to go.
Okay, so I have a question. Gets the right answer, gets some serious swag.
So everybody's listening now.
Who are you going to call?
Yeah.
Jim Crow.
That's not the question?
That is the question.
Oh, there you go. All right, well. Yeah.
Since I saw Allison struggle so mightily
Yeah.
in the use of this high technology pen here, I'll explain it to you. First of all, take off this little plastic cap. This becomes a nightlight. Oh. This is the pinpoint function, and then we have the third function, which is the stylus.
Very nice. So thank you very much, Jim.